Peter, with the at the risk of prolonging the technical side of things, a quick question about strategy. We'll get to the real strategy in a second, but thinking about skip persons and direct skips
Yeah.
and taxable distributions, when advisors and their clients are thinking about this, or lawyers and their clients are thinking about this, Valor and our clients, when you're thinking about this with people, does it make sense to let the tail wag the dog and like plan to gift to only the next generation first to kick the can down the road? If I could gift outright to my kids or to a trust with only my kids as the beneficiaries and let them then deal with it down the road, is that a tactic that can make sense, or does that?
It almost never makes sense. So we actually get to this in the next, I think the next slide. Actually, maybe we should just shift to the next slide. Yeah. How to minimize GST taxes. And so basically, the GST rules strengthen the case for using dynasty trusts as opposed to making outright gifts to your children. And the reason is if you can gift assets into a dynasty trust sooner rather than later, that means that you can shield the assets in the trust not only from estate and gift tax in the future, but also from GST tax. And so if you just make an outright gift to your kids, that those assets aren't going to be subject to estate tax when you die. But when your kids die, there's going to be estate tax on their death. If you get assets into a dynasty trust, it's, at least in our current law, it's 100% exempt from any sort of transfer tax ever in the future. You set up a South Dakota dynasty trust, it can last forever. It'll never have a taxable distribution. It'll never have a taxable termination. It's just completely outside of the transfer tax system entirely. And so you really want to get assets into GST exempt dynasty trusts as soon as possible. And it's also another reason why you don't want to gift directly to children or even directly to grandchildren, because any direct gift is eventually going to come back into the transfer tax system. Whereas anything that's in a trust, in a dynasty trust, that's GST exempt, is literally outside of the system entirely and will never come back into the system unless Bernie Sanders gets his way and kills the GST tax exemption.
Yeah.
But yeah, so that's the basic idea is, number one, you always want to use irrevocable trusts, dynasty trusts, and allocate GST exemption to those. There's narrow situations where it makes sense to not allocate, but 99% of the time, you want to make gifts and allocate GST exemption to.
And then jumping to number 4, because this is a natural question, a GST exempt trust like a South Dakota Dynasty Trust is
Yeah.
just outside of the system.
Yeah.
And so then maybe spell out the logic of the argument that you should then avoid making distributions. If those distributions aren't going to be transfer taxable, who cares?
Yeah, so there's a couple things. So if you make a distribution from a dynasty trust, that distribution isn't going to be subject to gift tax, is not going to be subject to GST tax or estate tax or anything. So there's no immediate tax liability. The problem is once the money or whatever the wealth is outside of that trust, it's now back into the transfer tax system. And the only way to get it out again is for the beneficiary to make a gift to another dynasty trust. And so if you have a beneficiary that says, I want to take a distribution so that I can make a gift to a new dynasty trust for the same beneficiaries, probably doesn't make a ton of sense, because if they left, let's say the beneficiaries would be their children and grandchildren. If the dynasty trust is already for the benefit of them and also their children and grandchildren eventually, you're much better off leaving those assets in the trust and not using your personal exemption rather than withdrawing them and then using your exemption for essentially no reason. And so in general, it almost never makes sense to take assets out of a trust that's already GST exempt. You're better off leaving them there. Sometimes people say, I need a distribution because I want to buy a house or XYZ. And so a couple things. One is, in cases where you have both GST exempt trusts and non-GST exempt trusts, you want to take the distribution from the non-GST exempt trust. And this is like fairly common with high net worth families. And so if you're a financial advisor, for example, this will probably come up, at least if your clients are wealthier, this will come up, which is that if somebody died with $100 million estate and they only had a $14 million GST exemption, chances are the vast majority of the assets that were left in trust for their children were left in GST non-exempt trusts, and a smaller slice were left in a GST exempt trust. And so you want to treat the GST exempt trust as like special and not to be distributed from. And you want to treat the GST non-exempt trust as less special. And so whenever you're looking for a trust to take a distribution from, you always want to look first for the GST non-exempt trust, if there are any, and take it out of that first before you start dipping into these GST exempt trusts, which are more tax advantaged.
Tactically, let's imagine that a family has both kinds of trusts. They've been set up by the patriarch and matriarch. They've been running for a while, and now we're down the generations. This is a question that I think comes up a decent amount when I'm talking to prospective partners and
Yeah.
clients. Tactically, who's making that decision as to which of the trusts the money is coming from? Of course, this is something that we work with
Yeah.
our clients on, and we talk about what those
Yeah.
distribution provisions are and who's deciding. But just here for the audience, I think it's worth talking about who's thinking about this.
So the person who actually makes the decision is the fiduciary, so which is either the trustee, or in some trusts it'll be someone called a distribution trustee or a distribution advisor. So that's the person who has the official responsibility to decide whether to make distributions or not. And so that's the person who actually makes the decision. In practice, a lot of times it's more of a consultation between a financial advisor, maybe an attorney, maybe someone, a CPA, someone else.
Yep.
Some other advisors, but it's the fiduciary who's actually ordering the distribution to happen.
Yep. I think this is a relevant question that comes out of this conversation.
Yeah. Is there a provision for the child to take only income, then the corpus to go to the second generation? It just depends on how the trust is drafted. The way Valor's trusts work and the way a lot of trusts nowadays work is there aren't any mandatory distributions. And so rather than the child or whoever being guaranteed to receive an income distribution every year, what the trust says is basically all distributions are discretionary. And so that gives the trustee or other fiduciary the option of retaining everything inside of the trust indefinitely. And so nothing has to be distributed. So you don't have to distribute income to the child. You could distribute income to the child if you think that makes sense.
Did you touch on loaning, selling, loaning?
Yeah. So I'll go to point 3 here pairs with points 1 and 4, which is you want to get as much of your assets into GST exempt trusts as possible, just because they're totally outside of the transfer tax system. And so the obvious way to get assets into a GST exempt trust is to make a gift to a GST exempt trust and allocate your exemption. But there are other strategies too. So if somebody's already used up their GST exemption, you can, for example, loan assets to the trust. And to the extent that the trust investments are able to outperform the interest rate on the loan, that spread will be captured by the trust. And that'll all be GST exempt too, assuming that the trust was GST exempt. For example, if you're borrowing from the grantor at 4% interest and then reinvesting it inside the trust and generating 10% annual returns, that 6% spread between the 10% returns and the 4% interest rate is going to be captured inside the trust, which means that by the time the loan's repaid, the trust is going to have a lot of additional principal thanks to those additional returns. And so loans are a powerful strategy. Another sort of similar strategy is just selling assets to a trust. And so if the trust is what's called a grantor trust, the grantor of the trust can sell the assets to the trust without recognizing any capital gain on the transaction. And so it's an ignored transaction for income tax purposes. Let's say you have a $2 million asset that you think is going to be worth $10 million in 10 years. You can sell it to the trust for $2 million. The trust pays the grantor $2 million of cash or maybe a promissory note, but it captures all of that appreciation. And so in 10 years, when that $2 million asset is worth $10 million, that $10 million asset will be inside the trust, but the trust will only have paid you $2 million. And so that's another way to shift wealth into the trust, which is GST exempt, and get assets out of your personal estate.
Yep.
And
so
then,
go ahead.
No, you go ahead. Yeah.
We have a little less than 10 minutes left. In a sense, everything up to this point has been, we hope, helpful to those who are watching, mostly so you can explain it to your clients, or if you're a prospective client of Valor, so you can understand these topics at a very high level. We don't expect you to understand the nuances of these strategies. That's where Valor comes in. We can help you think through them and help your clients think through them. I do think it's worth saving now a few minutes to really just to talk about numbers. We have a little case
Yeah.
study prepared. And I think it's worth just giving folks a high level idea of literally how much money this sort of planning would save. We don't expect you to leave here, those who are watching, with an understanding that's going to allow you to implement this stuff yourself, but rather to identify this as an issue, to see that it can save you a big chunk of money, and to say, all right, I need to talk with someone like Valor to start planning.